Hello girls, I hope you all are doing good. So let's begin with your fourth chapter, that is commodities market. Okay, if you all are aware, we are studying stock and commodities market and we are in the fourth unit, which is known as the commodities market. So let's begin with the introduction to commodity market. Now in introduction to the commodity market, as we all know, India is a commodity based economy, right? Why is India a commodity based economy? Because here 2/3 of 1 billion population depends on the agricultural commodities. As we all know, agriculture is the main business of various people in India. Most of the contribution to the GDP comes from the agriculture sector. 70% of the GDP which is being contributed is from the agriculture. Okay, so here when you talk about the agricultural commodities and when you talk about the commodity market, you have the physical market. Unlike the physical market, you have a futures market. Okay, now what is this futures market? Futures market is a market where the trades in commodity are largely used as risk management. What is it? Risk management, that is your hedging the risk. Okay, now what is this hedging? Hedging is basically you are taking advantage of the price change, price fluctuation. Okay, when the prices are high, you are selling it. When the prices are low, you are purchasing it. Okay, future market trades in commodity are largely used as risk management, that is hedging mechanism on either physical commodity itself or open positions in the commodity stock. You are either doing it in the physical commodity itself or in the open positions in the commodity stock. Okay, now India, as we all know, is one of the top producers of large number of commodities, because we all know India deals in agriculture. So we are growing. What is commodity? Commodity are various things. You have your wheat, ragi, rice, jowar. All of these are commodities. You're dealing in commodities here, not in your shares, stocks, etc. Nothing as such. You're dealing with your commodities here. Okay. Now next, moving on to the history. Now in the history, you have commodity future trading was evolved from the need of assured continuous supply of seasonal agriculture. Here they found that there is a need for the assured continuous supply of seasonal agricultural crops. Okay, and the concept of organized trading in commodities, which is has been evolved in Chicago in 1848. So this basically the entire concept of commodity market and commodity trading was evolved from Chicago in 1848. Okay, but here you can trace its roots. It has started, your concept is actually started in Chicago, but you can find its roots already existing in Japan. So basically in Japan it was already existing in the 19th century. In the 19th century, Chicago in United States had merged as a major commercial hub. So here major commercial hub, they merged as a major commercial hub to deal in the commodities. Various countries came into a picture and they had a physical trading of the commodities. Suppose India has wheat. Okay, suppose for example Bangladesh has wheat, India has ragi. So in India and Bangladesh will come with each other. India will provide them ragi and they will provide us with wheat, for example. Now what is this futures trading? Futures trading is basically you are entering into the future price. You are trading in present by wherein you are agreeing with the seller to provide the commodities for a future period. You can either enter in the current price or in the future price. Okay, now there were various boards which were actually established, that is Chicago Board of Trade, which was established in 1848, and in 1870 and 1880s the New York Coffee, Cotton and Produce exchanges were actually born. So here agricultural commodities were actually traded. Now we all know what is commodities, so obviously it will be agricultural commodities, that those are the primary commodities. When you're talking about commodities, you should always know there are two kind of commodities, that is primary commodity and secondary commodity. Now agricultural commodity is your primary commodity, which were actually traded, and there were more number of buyers and sellers. Okay, and there was a lot of trading which was happening here. Now next, let's move on to your next topic, which is the history of Indian commodity market. Now what is this history of Indian commodity market? As we all know, commodity futures markets largely remain underdeveloped in India, right? Because most of them here are not not educated, so most of them depend on agriculture for their income. So based on that, they do not know how the markets actually work and how they have to go about dealing in the commodity market, how the commodity market has to be actually developed. So it has largely remained underdeveloped in India, but whereas in other countries it has been developed. Okay, and it only gained a lot of recognition due to the intervention of the government, wherein the government brought in the commodities market, wherein the recognition, wherein the farmers, the buyers and sellers, everyone got a recognition. So here it also, you should remember these acts which have been enforced for the commodity market. That is your Essential Commodities Act, ECA, in 1955, and forwards as well as future contracts are limited to specify commodity items listed under the Forward Contract Act, that is FCRA, that is Forward Contract Regulation Act in 1952. With the help of these acts, various commodities were being established, they were being listed. Suppose you have agricultural commodities in one, you have your gold, silver, etc. You had different headings for it. So it was all established under different headings, under different acts. All of these acts are related to your commodities. Now, the evolution of organized futures markets in India commenced in 1875 with the setting up of Bombay Cotton Trade Association Limited. Now, Bombay Cotton Trade Association Limited is basically a separate association, okay, which was constituted in 1983. Here, it basically made sure that it was trading in futures, trading in oil seeds, originated with the setting up of Gujarat Vyapari Mandali in 1900. Okay, this Gujarat Vyapari Mandali was also a kind of association which was being set up for trading in the commodities. Okay, here it was carrying out future trading in groundnuts. Okay, mind you, it is groundnuts, castor seeds and cotton. Now if you want groundnuts, now suppose you are entering into a contract with me. Now suppose it was a chocolate, I can make it available to you right now. But if you want groundnuts or if you want castor seeds, you have to wait for a certain period of time because it grows in a particular season. So when it is growing in a particular season, the buyer will enter into a contract with the seller and tell the seller that after this particular period or season is over, when the seeds are once grown, when the groundnuts are once grown, provide it to me, supply it to me. So you are entering into a future contract and not a present one. The Calcutta Hessian Exchange Limited, the East India Jute Association Limited, all of these were actually set up in 1919, 1927 for respectively, they were set up only for futures trade in raw jute. Okay. Now, post the independence, the Indian Constitution listed the subject of stock exchange and future market in the Union list. So, only post independence, the future exchanges and the stock exchanges were listed in the Union list of the government. Okay. So, now this Professor A.D. Schroff basically and selected committees of two successive parliaments, and finally in December 1952 they actually brought into consideration the Forward Contract Regulation Act. These people brought in effect, came up with a act called Forward Contract Regulation Act, which was enacted, and this particular Forward Contract Regulation Act was notified, and it got a recognition from the central government in 1954. Okay, it were various associations actually came into consideration after this particular act. You had Indian and Pepper, to name a few, it is Indian Pepper and Spice Trade Association, so etc. Now what happened after this was basically after various associations came into existence and after all of after the future Forward Contract Act was established, it was enacted, you can also see there was an introduction of economic reforms. Now we all know what happened in economic reforms of 1991, right? That was liberalization, privatization and globalization, which because economic reforms is very has gained a lot of popularity and gained a lot of recognition because of the LPG, that is liberalization, privatization and globalization, which happened in 1991. Now, the Government of India appointed an expert committee on forward market under the chairmanship of Professor K.N. Kabra in 1993. Okay, here they formed a committee in 1993 in September, and it also came into existence wherein the report was submitted in September 1994, wherein you also went in for the reintroduction of the futures. Mind you, we told a forward contract, right? Now we are talking about futures, which is gaining recognition here. Forwards have got recognition. Now we are talking about futures, which is gaining recognition. Okay, so this is about the Indian history. So this is about the history of Indian commodity market. Now next, let's look into the governing or governing body and the regulating body. Now what is this governing body or the regulating body? Okay, the commodity futures traded in commodity exchanges are regulated by the government. Okay, we told there was a forward committee which was being established by A.D. Shroff. So the commodity futures are traded in commodity exchanges are regulated by the government. Whatever commodities are traded in the market are regulated by the government under the Forward Contract Regulation Act of 1952. And the rules are framed. Okay, there is a framework wherein they have to follow the rules and regulations to carry out any purchasing and selling of commodities under this particular act. Now this Forward Market Commission is basically a statutory institution which is being set up in 1953 under the Forward Contract Regulation Act of 1952. Commission consists of minimum 2 and minimum 2 it is consisting, and maximum 4 members which are appointed by the central government. Now out of these members, basically there is one member who is nominated, who is known as the chairman, and all the exchanges have set up under overall control of Forward Market Commission, FMC, of the Government of India. Now what is the responsibilities and the functions of Forward Market Commission? Forward Market Commission, the roles and responsibilities are basically to advise the central government. Okay, why are they advising the central government? To gain recognition or withdrawal of recognition from any association or in respect of any other matter arising out of the administration of the Forward Contract Regulation Act. Now they are advising the central government in terms of the Forward Contract Regulation Act to either gain certain recognition within this particular act or to remove certain things from the Forward Contract Regulation Act, to keep forward markets under observation. Okay, the FMC, another second function is basically to keep the markets which are dealing with the commodities, commodities under observation. Okay, and when they're keeping it under observation, there are certain people who will have certain rules and responsibilities, and these people will be appointed. Now when these people are appointed, they have certain powers under which they can exercise it under this particular act. To collect and whenever the commission, okay, their main responsibility, again their function is to collect the commission if they think it is necessary. Okay, they need to collect the necessary commission for it. Okay, and they should also prepare periodical reports on working of the Forward Market Commission relating to any goods. Now to make recommendations. To make recommendations to whom? Basically they are making recommendations to the government, generally with the view of improving the organization and working of the forward markets. Now here you can make recommendations to the government or also to the Forward Market Commission or the committee who is dealing with the forward market, to undertake the inspection of accounts and any other documents of recognized association or registered association or any member of such association whenever it is considered as necessary. There also the last responsibility or the function is basically to undertake inspection of accounts, wherein they will be accountable, wherein they have to prepare necessary documents to see if there is if the association is recognized, if the association is registered, if there is any if there is any changes or any necessaries that need to be made, they will take all of this into inspection and in control. Now next one, we will move on to talking about the membership of the FMC, that is Forward Market Commission. How to become a member of the commodity exchange. Now let's look into the eligibility criteria. He should be the citizen of India. The main and the first criteria is he should be the citizen of India. Now, and he should have completed 21 years of age. He should have graduated or having equivalent qualification. He should not be a bankrupt. Because once he is the member of the commodity exchange, a bankrupt cannot be a member because he will not have any assets or any money to support himself. So there are chances that he can commit fraud in the commodity market also, in the commodity exchange also. He has not debarred from trading in commodities by statutory or regulation authority. So you should make sure that he is not a bankrupt, and also make sure that there is no legal proceeding which is going on against him, and he is also not barred, okay, debarred from trading in commodities. He should have not committed any frauds, because of which they have banned him in trading in commodities. Okay, now there are following 3 types of memberships. Okay, now there are 3 types of membership under your commodity exchanges. To name a few, you have trading cum clearing member. Okay, there are 2 types of trading cum clearing member. Now the first one is, I will write it down for you all. See, first one is trading cum clearing member. As we looked here, there are 3 types. Second one is this one, and third one is PCM. Okay. Now in first one, trading cum clearing member or trading cum clearing member is entitled to trade on his own account, okay, as well as on his account of his clients, clear and settle trades himself. Okay, now he is trading in his own account, he is clearing the trade, and the settlement is done by himself. Now this can, for example, be a joint Hindu divided family, a corporate entity, or it could be a single partnership or a sole partnership firm which is owned by a single person. There are 2 types of TCM, that is TCM 1 and TCM 2. Now TCM 1 refers to your transferable non-deposit based membership. Now what is this transferable non-deposit membership? Is basically here a person desires to register as a trading cum clearing member. So he is required to submit application as per the format prescribed under the business rules and regulations. He also has to pay fees in order to become the member, and he should submit the various documents. Secondly, if you want to become a non-deposit, TCM 2 refers to non-transferable deposit member. Okay, now in non-transferable, first one you looked into transferable. Now non-transferable is basically, here you will also be paying a certain amount of fees and submitting of documents, and you will be following rules and regulations. Now next moving on to institutional trading cum clearing member. Now only an institution or corporate can be admitted by the exchange as member, conferring upon them right to trade and clear through the clearing houses exchange institution trading cum clearing member. Okay, that is ITCM. Now he may not be allowed to make deals for himself, but he will be allowed to for himself or on behalf of his clients. Okay, now he can do it he cannot do it for himself or trading on behalf of his clients and clear and settle such deals. Okay, because he has to appoint for sub brokers. Authorized persons in trading members should be registered under this particular thing for trading. Okay, he can unless and until he is not registered, he cannot do it. So he has to appoint those people who are actually registered under this thing. Professional, next one, let's move on to the next one, that is professional